Estate planning should be an essential part of your overall financial planning strategy, but is not always the easiest. Because there are so many areas of taxation that apply to estate planning, it tends to be a more nuanced and often more complex form of planning. A good estate plan will take into consideration three primary tax areas: income tax, estate tax, and trust tax. While there's some overlap between these three areas, each is a distinct type of tax with its own unique rules and applications. Planning for one may have an impact on one or both of the others, and that impact may not always be beneficial. So it's important that you have a good team of advisors in your corner who know how to balance the pluses against the minuses in order to arrive at a plan that will be most tax advantageous for you. In 2016, a higher exemption rate of $5,450,000 per person is being implemented. Due to this change, fewer taxpayers will be subject to the federal estate tax. This represents a real shift and means that estate planning for these individuals will be driven less by tax-related considerations and more by lifestyle considerations, such as blended families, households where someone is caring for an elderly family member or disabled child, or a person's charitable intentions. One thing to bear in mind is that in the event a spouse passes away, the surviving spouse has the opportunity to not only use his or her own exclusion amount, but also the unused exclusion amount of his or her deceased spouse. To take advantage of this option, the executor of the decedent must make an election to allow the surviving spouse to use the deceased spouse's unused exclusion or DSUI amount. So although you may not be subject to estate tax yourself, you may still need to file a federal estate tax return so that you can make this type of election. Think of your estate plan as a fluid plan and be sure to revisit it on a yearly basis. You'll also want to review it when your family dynamics change due to a marriage, divorce, birth, or death. Finally, you'll want to take a look at your existing plan as new legislation takes effect, as it may impact the planning you do today or down the road. Whenever possible, make sure to consider the full range of scenarios that might impact your plan and weigh the various outcomes of each with your advisory team. By taking a careful look at all the eventualities and outcomes, you'll be in the best possible position to effectively maximize your planning opportunities and ensure that your wishes are accounted for in the plan. Typically, funds inherited from an estate aren't considered income for purposes of the beneficiary's own income tax liabilities. However, there are exceptions to this general rule, such as income earned by the estate and distributed to a beneficiary, or withdrawals taken from an IRA account. If you are a beneficiary, make sure to discuss any income tax implications with your accountant. You'll also want to be aware that just because you may not be subject to the federal estate tax doesn't mean your resident state will follow suit. The state you live in may have its own estate tax regulations that will cost you. For example, New Jersey is both an inheritance tax, which is a tax determined by the relationship of the beneficiary to the decedent, and an estate tax for gross estates valued over $675,000. As of 2015, 6 states have an inheritance tax, and 16 states have an estate tax. Finally, when tackling your estate planning, be sure your estate attorney, accountant, and financial advisors are coordinating and communicating with each other to keep the process working seamlessly. If you have any questions about estate planning and taxation, contact your Untracked Early advisors for more information. I'm Rebecca Alicea with Untracked Early.